Ladies and gentlemen, welcome back to the channel. So, there is something happening right now inside the Federal Reserve that almost nobody fully appreciates yet. And depending on how this plays out over the next few months, the next year, and honestly the next 4 years, it could completely reshape the investing environment that people have become used to since 2008. Because for the last 15 years, investors have lived through a world where the solution to almost every economic problem was easier money. Markets crash, inject liquidity. Economy slows, cut rates. Banks get stressed, open emergency lending. Housing weakens, lower borrowing costs. And over time, investors got conditioned to believe the Federal Reserve would always step in before things got too painful. But now, for the first time in decades, we could be entering a completely different era. And what makes this even more important is that the market itself no longer seems convinced the Federal Reserve is fully in control of inflation. That's the real story. Because right now people keep asking the wrong question. Everyone keeps asking, when are rates going down? But that's not actually the important question anymore. The real question is this: even if the Fed cuts rates, will borrowing costs actually fall? Because those are no longer automatically the same thing. And over the next few months, that distinction could become painfully obvious. Right now, the bond market is essentially sending a message to the Federal Reserve saying, we don't fully trust where this is going. And when trust disappears, long-term yields rise. Mortgage rates stay elevated. Lending tightens. Housing freezes. Businesses slow hiring. And investors suddenly start caring a lot more about profitability than hype. That is the environment we're moving into. Now, over the next 3 months, this is where things start getting very uncomfortable for the market. Because inflation is still stubbornly elevated, oil prices remain volatile, geopolitical tensions are pushing commodity prices higher, and investors are beginning to realize that cheap money may not come back nearly as quickly as they expected earlier this year. That changes everything. And I really want people to understand this part, because most casual investors completely overlook it. The Federal Reserve directly controls short-term interest rates, but mortgage rates, long-term borrowing costs, corporate debt, and a huge portion of the real economy are influenced far more by the bond market itself. So, even if the Fed tries to ease policy later this year, investors can still demand higher yields if they believe inflation is going to remain elevated. That's why we're in this weird environment right now, where people keep hearing eventual rate cuts, but mortgage rates are still painfully high and affordability is still awful. The market is basically saying, we don't believe inflation is fully dead yet. And honestly, from the market's perspective, there are reasons to be cautious. You still have elevated government spending, you still have huge deficits, you still have persistent wage pressure, energy prices are unstable, and now investors are trying to figure out whether this new Fed leadership is actually going to stay aggressive on inflation or quietly pivot toward protecting growth and the stock market. Now, before we continue, quick disclaimer and a quick shout out. If you are looking for an easy-to-use financial platform that combines personal banking, savings, loans, credit cards, investing, and crypto all in one place, you can check out SOFI. Right now, eligible new users may be able to earn a bonus when opening a checking and savings account and setting up qualifying direct deposit. At the time of recording, the offer includes a possible $25 bonus for opening an account, plus additional direct deposit bonuses for eligible users. Terms and conditions apply. This is a referral link, which means I may receive a referral bonus if you sign up through it, so it helps support the channel at no additional cost to you. This video is not sponsored by SOFI, and this is not financial advice. Always do your own research and review all terms before opening any financial account. Check out the link in the description. Now, back to the video. That uncertainty alone creates volatility. So over the next 3 months, I think you're likely going to see markets become much more reactive to economic data than they've been recently. Every CPI report matters, every jobs report matters, every oil spike matters, every Fed speech matters. And that means we could see much sharper swings in both directions. A hot inflation number could send yields flying higher overnight. A weak jobs report could trigger a rally because investors start pricing in cuts again. And meanwhile, the average person is sitting there wondering why everything still feels expensive, even though inflation is supposedly coming down. That disconnect is becoming a major issue psychologically, because inflation slowing does not mean prices go back down. It just means prices are rising more slowly. And if rates remain elevated while prices stay high, consumers eventually start pulling back. That is one of the biggest risks moving into the second half of the year. Now, as we move into the next 6 months, this is where the separation inside the market probably becomes much more obvious. And I think this is where a lot of investors are going to realize we're no longer in the same investing environment we had from 2020 through early 2022. Back then, money was everywhere. Speculation exploded. Companies with no profits could double overnight. People were buying anything with AI in the name. Crypto was exploding. SPACs were exploding. Growth at any price worked because money was cheap. But when rates stay high, future profits become worth less in today's dollars. That's the math underneath the entire market. And suddenly investors start becoming a lot more selective. Now profitability matters, cash flow matters, debt levels matter, balance sheet strength matters, because refinancing debt becomes more expensive. Expansion becomes more expensive. Hiring becomes more expensive. And weaker companies start getting exposed. That doesn't necessarily mean the entire market crashes, but it does mean the market environment becomes less forgiving. The companies that survive are usually the ones with real earnings power, pricing power, and manageable debt. Meanwhile, businesses dependent on cheap financing start feeling pressure. And honestly, housing might be one of the biggest casualties of this entire environment, because housing right now is trapped. Existing homeowners don't want to give up ultra-low mortgages from a few years ago. Buyers don't want today's rates. Builders are trying to use incentives to keep transactions alive. And affordability is still historically stretched in many markets. So unless rates meaningfully decline, and more importantly, unless long-term yields fall, housing could remain frozen for a lot longer than people expect. And that creates ripple effects everywhere. Construction slows. Furniture demand slows. Mortgage lending slows. Refinancing disappears. Consumer spending weakens. Because housing is deeply connected to the broader economy. At the same time, though, not everybody loses in this environment. This is something people forget. There are absolutely winners in a higher rate world. Savers finally earn real returns again. Money market funds become attractive. Treasuries become attractive. CDs become attractive. Banks can potentially earn wider lending spreads. And disciplined investors with cash suddenly have optionality again. That's a huge change psychologically from the zero-rate era. Cash used to feel useless. Now cash has value again. And honestly, that changes investor behavior dramatically. Now, once we move into the one-year timeline, this is where we find out whether this transition becomes a true monetary reset or just another temporary rate cycle. Because over the next year, the Federal Reserve is going to face enormous pressure from every direction. Politicians want growth. Markets want lower rates. Consumers want affordability relief. Businesses want easier financing. But if inflation stays elevated, the Fed may not have the freedom to deliver any of that quickly. And this is where credibility becomes everything. Because central banking is heavily psychological. If investors trust the Fed, inflation expectations stay stable. If investors stop trusting the Fed, yields rise because lenders demand more compensation for risk. That's why this next year matters so much. The Fed is not just fighting inflation anymore. It's fighting for credibility. And if the market starts believing the Fed is becoming political or too focused on protecting markets instead of controlling inflation, long-term yields could remain elevated even if short-term rates come down. That is the scenario investors are terrified of, because that creates the worst of both worlds. Slower growth, but still expensive borrowing. That environment becomes extremely difficult for consumers, especially consumers already carrying high-interest debt. Credit card rates are already crushing people. Auto loans remain expensive. Personal loans remain expensive. Small business borrowing remains expensive. And if rates stay elevated into next year, the pressure on lower and middle-income households could intensify significantly. At the same time, the federal government itself starts facing a serious problem. Because as Treasury yields rise, interest payments on the national debt rise with them. And once interest expense becomes a larger portion of federal spending, deficits grow even faster, which means more borrowing, which can then pressure yields even further. That feedback loop is one of the biggest long-term concerns in the entire economy right now. And honestly, I don't think enough people are talking about it. Because eventually you reach a point where high rates themselves become economically restrictive, not just for consumers, but for the government too. Now, zooming all the way out to the next 4 years, this is where things get genuinely fascinating. Because by then, we're going to know whether this was simply a rough transition period or the beginning of a completely different monetary era. And personally, I think there's a real possibility the investing environment of the next decade looks very different from the investing environment of the last decade. For years, investors were rewarded for maximum risk-taking. Leverage worked, speculation worked, unprofitable growth worked. Buying every dip worked because liquidity always returned eventually. But if inflation remains structurally higher than the pre-2020 era, that entire dynamic changes. The market becomes much more selective, capital becomes more expensive, and investors become far less tolerant of companies surviving entirely on hype and borrowed money. That doesn't mean innovation disappears. AI could still dominate. Technology could still outperform. Markets could still reach new highs eventually, but the path becomes much more dependent on actual earnings growth instead of pure liquidity. And honestly, that's probably healthier long-term. Painful in the short term, but healthier long-term. Because economies built entirely on cheap money eventually create distortions. Asset bubbles form, debt explodes, speculation explodes, and eventually something breaks. That's why I think the biggest mistake investors can make right now is assuming we're automatically going back to the exact same environment we had a few years ago. We might, but we also might not. And smart investors prepare for both possibilities. Personally, I think the investors most likely to survive this environment are the people who stay diversified, avoid over-leveraging themselves, maintain some liquidity, and stop assuming the Federal Reserve can instantly rescue every market decline. Because over the next 4 years, there's a very real possibility that stability itself becomes more valuable than aggression. And honestly, that is a massive psychological shift from what investors got used to after 2008. So, when you really step back and look at the bigger picture here, this entire story is not actually about one Fed chair. It's not even really about rate cuts. It's about whether the financial system can transition away from emergency-era monetary policy without breaking confidence in the process. Because confidence is everything. If investors trust inflation will remain controlled, yields stabilize. If investors trust the Fed is independent, markets stabilize. If investors trust long-term purchasing power remains intact, the system stabilizes. But if that trust weakens, the cost of money rises. And once the cost of money rises, everything changes. Housing changes, stocks change, debt changes, consumer behavior changes, business investment changes, government spending changes, the entire economy changes. And that is why these next few years could quietly become one of the most important economic transitions we've seen in decades. Now, obviously, none of this is financial advice, and these are simply macroeconomic scenarios worth paying attention to. But personally, I think investors should prepare for a world where rates stay higher longer than many people currently expect. And if that ends up being true, the winners over the next few years are probably not going to be the people chasing the most hype. It's probably going to be the people who stayed patient, stayed disciplined, managed risk properly, and understood that eventually fundamentals matter again. And honestly, that adjustment process may have already started. So, on behalf of all of us at Investing for Normal People, we extend a sincere welcome to Mr. Kevin Warsh as he assumes the office of Chairman of the Federal Reserve. No matter the political persuasion of a man, nor his station in the economy, one truth stands plainly before us all. You now enter one of the most consequential financial periods this nation has witnessed in many decades. Inflation weighs heavily upon the American household. Debt burdens continue to rise. Housing grows ever more difficult to attain. Global uncertainty casts a long shadow across the markets, while confidence itself has become a matter of grave importance. At this hour, millions of Americans look toward the Federal Reserve with hope for steadiness, prudence, and responsible leadership. We recognize the immense burden of the office you now hold, and we offer our genuine respect and best wishes as you undertake the responsibilities of Federal Reserve Chairman. For whether the public fully realizes it today or not, the decisions made over these coming years may very well shape the economic future of an entire generation.